Today is February 26, 2016, and this is ADMIS Weekly Market Review. Today we'll be talking to Steve Freed, the Vice President of Research at ADM Investor Services, and also to Alan Bush, the ADMIS Senior Financial Economist. Please note that the opinions expressed in this video are the opinions of the guests and are not the opinions of ADM Investor Services or Archer Daniels Midland Company. We had an active week in the financial markets with some movement in bond prices. So Alan, my first question is directed toward you. In light of the Fed's decision to increase interest rates last December, what is the outlook for Fed policy now?
Okay, it looks like the Fed is probably going to be on hold for a while. The feeling is that they will not be able to raise interest rates this year. In fact, the probability of a rate increase at the December meeting is now about 35%. And that compares to in the first week of January, where prospects of a rate increase at the March meeting was at 55%. So clearly the Fed is backing away from its hawkish rhetoric.
And Alan, the U.S. dollar fell hard in the first week of February when it became apparent that the Fed was likely to be less hawkish in 2016. What is the main trend for the U.S. dollar now?
Okay, even though the dollar has had a bit of a setback a bit earlier in February, it still looks like the dollar is going to be the strongest of the major currencies since, of course, keep in mind that the Fed is the most hawkish of all of the major central banks, even though they are a bit less aggressive in their interest rate hike talks. So with that in mind, we can expect the dollar index to advance all of this year, and that would be against all of the major currencies.
It's been a good week for stocks. Earlier this year, stock index futures set back due to a variety of geopolitical events. What is the outlook for stock index futures going forward?
Okay, well, if we're correct in our thinking that the Fed is not going to be raising interest rates this year, they may have to hold off until 2017, plus all of the other major central banks, with the possible exception of the Bank of England, are on an easing course, and that would include the European Central Bank, the Bank of Japan, People's Bank of China, all are adding more stimulus. So we are expecting stock index futures to continue to recover, and I think in spite of the very rocky start to this year for the indices, I think that 2016 will be a positive year across the board for all of the major stock index futures.
Shifting toward world commodities, Steve Freed, there was a very important USDA Outlook conference this week. Can you highlight some of the key takeaways from that meeting?
First of all, the USDA said that macroeconomy is weighing on trade, and that they also saw in U.S. record crop harvests that led to stock building and downward pressure on prices. So I think the main thing that came out of that is you could have a potential volatile year, and that traders should be looking for wide swings in prices depending upon weather. The USDA also said that farm income and farmland values are adjusting to this, but right now, for the majority of farmers in the U.S., they're looking at a negative cash flow this year.
And El Nino continues to be in the news. Hear a lot of talk about El Nino. Steve, can you comment on how this may affect the 2016 crop?
First of all, we've seen quite a few private analysts' estimate of weather this year in the United States. And it goes from basically normal up to drought conditions this summer. So that extreme and wide variance also offers a lot of volatility in the market this year. The two big thing is that as you shift to La Nina, the tendency is for U.S. weather to be drier in the summer than it is in normal. So it's very closely watched as to when this is going to happen. The other thing that's kind of noted is that we had a wet November and December. And 7 of the last 9 times that's happened, the U.S. had a dry summer, and corn yields were actually below trend. So you have a tremendous amount of volatility due to weather this year. We're coming in with big stocks where prices are low, but you have a lot of uncertainty as to globally how this weather is going to pan out.
Let me just throw this out there for either of you to comment on. The upcoming G20 meeting. What do you think the group of 20 could do to stimulate the world economy if the outlook weakens?
Well, I think the tools that the G20 has are all of the tools that they've employed in the past, such as lowering interest rates, more quantitative easing. It appears that the People's Bank of China right now has the most tools in the toolbox to add more stimulus. So even as Jack Lew said, he does not expect a crisis response at the end of the G20 meeting, basically because currently there is no crisis. So we would expect a general ongoing feeling that there will be more stimulus and that the G20 is monitoring the economy, and if the global economy does weaken, they have plenty of tools available to alleviate the situation.
And I would add that you've seen a few forecasters talking about maybe the world is slipping into a recession. In the last couple of days, we've seen world stock markets. We've also seen crude actually rally in front of the G20 meeting in hopes that many businesses and many countries are asking for the G20 to come up with some kind of plan in case the world economies get worse. And so I think there is some thought process that if they could come up with a plan, it would help bottom some of these markets.
And finally, if you would, please comment on the potential impact that the China 2016 policy meeting might have on the U.S. and world economies.
Okay, my belief is, I would think somewhat of a minority view. I'm thinking that the Chinese economy is bottoming and will do much better than most analysts anticipate in 2016 and beyond. Now, one reason I think that is the case, that just a bit over a year ago, the People's Bank of China embarked on a new stimulus program. In fact, it was a very massive program, and it normally takes about 12 months for that type of stimulus to filter through the system and eventually show up in an economy. And we are already beginning to see that with Chinese loans showing a large increase, also Chinese M2 also showing very substantial gains in the most recent reporting period. So China, I think, is on the road to recovery, contrary to what most analysts are thinking right now.
I think that's a really critical point, too, that Alan has made, because I think the world is hoping for China to bottom. You've seen copper prices this week rally, and that's kind of an indicator that maybe China's economy is bottoming. The agenda at the meeting, they're going to be talking about all their excess supplies, which could include crops like soybean and rapeseed and corn and wheat. They have record supplies of everything that they have, and that's their fourth largest budget cost, and they're trying to bring that cost down. They're going to talk about their aging population. They're going to talk about IPO reform, which could help their stock market if they become more selective on which companies are listed on their stock market. They're also going to be talking about some of the reforms that they need to do to help their economy. They actually may talk about increasing their defense spending. Some people thought about adding to their debt to help their situation in their economy. So from a market standpoint, like crude oil, stock market, copper, this is a critical meeting to see if they have an agenda to improve their economy.
Again, the thoughts and opinions expressed in this video are solely the opinion of our guests and not the opinions of ADM Investor Services or Archer Daniels Midland Company.
If you want to contact us about any information that we talked about today or any tools on risk management that you might be able to need, contact us at www.admis.com.